Let's wait a couple seconds. And then I'll probably have some live questions, I imagine. But and then I think I told you I did go through all the like the day trading requirements that you went over with me.
Right.
So everybody should have that pretty straightforward. So,
okay.
Anyways,
I might touch on it really briefly, but it'll be quick.
Yeah. So, all right. Well, hey everybody. Thanks for showing up today. Here I'm with Sara Workman, who is my CPA, and is here to answer some of the questions you guys have asked and kind of get some stuff straightened out. So thank you.
Hi, how you doing? So I just want to start out actually by explaining taxes in general a little bit, the basics. That way, when we get into some of these questions, you'll have a foundation to really understand what I'm talking about. So first off, most people they go to work, they get a paycheck, they have a W-2 at the end of the year. That income is considered ordinary income, right? And those ordinary income has their own tax bracket system, and that's what everybody's familiar with, right? You get right now it's up to 37% highest tax rate on various different filing statuses. So if you're filing as a single person, it's one set of rates. If you're married filing joint, it's another set. If you're a head of household, it's another set. If you're married filing separate, normally you get screwed. That's what people are familiar with, right? So if you wanted to, I don't know if you already made it available for people to look at, but when you get a chance to look through those ordinary income tax brackets, it'll help you kind of visualize what we're going to be talking about a little more as we go. So there's that system. Then there's capital gains, right? That's what everybody's asking about with day trading is how are the capital gains treated? The capital gains, there's actually two different treatments on it. You have long-term capital gains, which means you've held the asset for more than a year before you sell it, or a year or more. And then there's short-term, and that is if you've held it for less than a year before you sell it. So those two have very different treatments. The long-term capital gains are have a benefit in having a completely different tax bracket system. It actually kind of follows the ordinary income tax brackets just in the way they're divided, but your max tax bracket with long-term capital gains is 20%. So and you can get as low as 0%. So the way that works is, let's take for example, and I don't know if this is something that you guys can see, but if you look at the capital gains tax rates and brackets for a single person, for example, up until you make $40,400, your long-term capital gains are taxed at 0%. So if say you had a $30,000 annual salary, you made $10,000 in long-term capital gains, those capital gains are going to be taxed at 0%. If on the other hand you have $30,000 salary, $30,000 in long-term capital gains, what the IRS is going to do, they're going to allocate all of your other income, your non-capital gain income, first, and say, okay, well, you've already used up $30,000 of this, $40,400 threshold. So then we'll let you have the next $10,400 at a 0% tax rate, and the remaining, what were the numbers I used? $19,600 are going to be taxed at a 15% tax rate. So they they allocate all of your other income first, and then they start filling in with your long-term capital gains. Does that make sense?
Yeah. Yeah, and I have those. I have that up. The resources that you sent over.
Perfect. Okay, so that's long-term capital gains.
Okay.
Short-term capital gains, you get no special treatment, right? They tax it the same way that they tax ordinary income. So that's short-term. Unfortunately, that's normally where day traders are going to fall. Day traders aren't normally interested in holding them for a year or more. But there's a couple other concepts I want to touch on before jumping into how everything applies to day trading. So, business owner, if you own a sole proprietorship, a partnership, or an LLC that's taxed as either a sole proprietorship or partnership, then your profits are going to be subject to what's called self-employment taxes. That is 15.3% of your profits on top of whatever ordinary income taxes you're generating from that. So that's pretty substantial. And ultimately, the purpose of that is to have the IRS recoup payroll taxes that they are not gathering by you just taking a wage, right? When you work as an employee, you get a paycheck, 7.65% of that paycheck goes to Social Security and Medicare, and then your employer matches another 7.65%, totaling 15.3%. If you are sole proprietorship, partnership, LLC is taxed as either of those, your profits are subject to that 15.3%.
Okay.
Another concept is qualified business income deduction. That is something that Trump put into place when he got into office. Basically, there's a lot of convoluted calculations involved, that if you own a business and you are under certain income thresholds and you have the right qualifying factors, then your profits can actually receive, you can receive up to a 20% deduction on all of your profits. So that's a bit of perk to being a business owner. And then the last little concept to really kind of fill you in on is the net investment income tax. That is 3.8% of an additional tax on anything that is like capital gains, interest, dividends, those kind of things, investment income. So rental properties, that kind of thing, where it's not you going out to work and making money. It is capital gains, interest. So it applies, right, to day traders. That's something you want to know about. So the important thing to know there is there should be a set of brackets there as well. There are actually thresholds. Once you make above this threshold, that's when they're going to start taxing that 3.8% on your net investment tax, and that all goes to funding Medicare. So basically, that is one of those taxes where they're trying to tax the wealthy in order to help fund the Medicare and that kind of thing. So just to kind of recap, we talked ordinary income, right? Capital gains, the long-term and short-term, how those are treated, self-employment, qualified business income deduction, and the net investment income tax. It's kind of a lot, but I want to apply that now to how that all goes with the
Yes.
right? So the nice thing about a day trader, and this is if you are a qualified day trader per the IRS, right? You guys have already talked about what that is and everything. But so there are some really good pros to being a qualified day trader. First off is you can actually deduct your business expenses, right? So for day traders, there's normally not a ton necessarily that you have to invest into becoming a day trader. I mean, some people might go through like coaching. You'll have your investment expenses. If you have a trading expense, you have home office expense, phone, computer, those kinds of things you can deduct. And what's important to know is if you are not a day trader, those expenses, yeah, you can kind of maybe deduct them, but it goes on your Schedule A. It goes on your itemized deductions, which first off, you may not benefit from if you use the standard deduction. And secondly, if you do, it's actually subject to a 2% threshold. And that means that you have to have spent more than 2% of your adjusted gross income before they start counting any of those expenses towards your itemized deduction that you may or may not get.
Okay. So
I have the forms 1040 in the Schedule A just so that you can kind of see those. But what's nice is as a day trader, you get to deduct those expenses, and it goes directly against income instead of maybe benefiting you. Right? Not benefiting you. So that's nice. Another nice thing is that day traders, the income that you get, it's not subject to self-employment taxes, right? That's, you own a business, most people, they have to pay that 15.3% tax. Day traders do not, because it's capital gains related, right? So that's a huge perk, 15.3% savings immediately. It also qualifies for that qualified business income deduction. So you get that potentially up to 20% deduction as well. Unfortunately, again, day trading, you normally don't hold things for more than a year. So everything's short term. You're taxed at the regular tax rates, and you might be subject to that net investment income tax if you're making good money, which I choose making good money. Right. Maybe have to deal with that 3.8%, but coming home with more money is normally a good thing.
Yeah.
So that was a lot of information off of that. Do you want me to delve into any of that, or should we go ahead and move on to some questions?
If anybody has, do you guys have any questions about any of that specifically? Let's see if anything pops up in chat about that. It is a lot of information.
You might have to rewind and watch it a couple times.
Completely, and I know even you and I went through it like twice before. It was like once, and then I digested it, and then that second time, it made a lot more sense.
You kind of have to sleep on it a little bit, look at a number of things.
Yeah, definitely, and at least it's all recorded, so we can double check.
Yes.
Yeah.
Yes.
No, I don't think so. So yeah, let's go ahead and dive into some of the questions that people had.
Okay. So you mentioned that you've already talked over what is required to be considered a day trader per the IRS, right? So the main things that they're looking for is like volume, frequency, holding period.
Yes.
Right? Those are some of the big things. And the IRS is really stringent. They know that this is kind of a nice gig if people can just start deducting home office and all this stuff because they spend a couple minutes on online day trading, right? Yeah. So they're really strict, and the reason I mention that is some of these questions are relevant in that case. So the first one that I have is, when should someone look into opening an LLC? Well, if you're looking to be considered a business by the IRS, that is one of the first things you want to do, is you want to actually set yourself up as a legitimate business, right? An LLC, the purpose of an LLC typically with most businesses is to protect yourself in the case of something going horribly wrong, and you might get sued or a crazy debt or whatever happens there. With day traders, that's not necessarily especially applicable, right? You're not going to get sued for day trading. Most cases, I can't imagine how a debt issue would be especially relevant in that case, because ultimately you lose money. Like you just lost money, right? It's not a debt issue.
Right.
So the purpose of the LLC in this case is just to further legitimize yourself as a business. And if your goal is to be considered a business by the IRS, that is one of the first things you want to do. Set that up. Another thing is that I know some of the different brokerages have kind of thresholds where they start making your life difficult, and what you're allowed to trade, how much you're allowed to trade at a certain time, frequently, all of that stuff. If you have an LLC, that actually allows you to open another account. So if you can have a personal account and a business account to trade out of, keep it below those thresholds. That way you can do as you please without having them say, oh, well, you have so much money, we want to make sure you keep it here for a certain amount of time, this, that, and the other. So it's another perk. It's a brokerage to brokerage. So something to look into as you are considering opening up a business.
Okay.
The next question we have is, when should someone consult with a CPA? So this is gonna sound biased. It is, I know, because I'm a CPA, I know. But honestly, it's better sooner rather than later. You want to know how everything applies to you. Everybody's situation is so vastly different that knowing what you're getting into up front it's really beneficial. And a CPA is the highest credential you can get in accounting and taxes, and having someone who knows what they're talking about it's at the very least a huge peace of mind, right? Knowing what's going to happen with you. It also gives you an opportunity for planning. So for example, again, if you are in certain income, if you're getting close to that long-term, short-term situation where you could benefit from having long-term capital gains and paying zero taxes on it, then you want to know, right? You want to know that, oh, if I hold this one just a little bit longer, it can be a long-term capital gain. I don't have to pay anything on it.
Yeah.
Right? That's the kind of thing where talking to a CPA up front is going to be beneficial. They also tend to know how it affects other elements of your life, because taxes go everywhere, right? They go for loans, they go for so mortgages, student loans. If you have any sort of government assistance, all of those things, like taxes is used for everything, health insurance. So you want to know, again, up front, how the extra income is going to impact the other areas.
Yeah, and from my perspective, I think it's huge just to know, like you said, there's so much unknown when you haven't contacted one. You have no clue, and then you get a ton of people Googling answers and just trying to look up, like, what am I paying in taxes? Am I paying a third, a half? Like, there's all sorts of misinformation. Right. And just to have that peace of mind, so at least you have a plan, like, I need to set aside 15% or 20% or something by the end of the year, and have an idea instead of guessing it's 40 and being freaked out. And
right. Or assuming that you only have to, set aside 5%.
Right, it's surprise.
40, right? Because I mean, these are federal tax rates. You have states that have their different rates, and each state is different. And if you're in California, sorry, you get a little bit screwed. Other states are better here and there, so each state is different. And that's actually one of the questions a little later that we'll get to. But the misinformation is a good thing to mention. One of the next questions talks about being able to deduct your losses, right? So when you have capital gains, you're only allowed to deduct $3,000 worth of capital gains against your other income each year. And so you get to keep the rest of it. You kind of save up the rest of it, and every year that you have other income, you can use up to $3,000. But that's it. It'll offset other capital gains all day long. But once you run out of capital gains to offset, then you're out of luck. So that is one of the things that I saw. One of the questions was that they kept hearing either 3,000 or 6,000. And my guess is someone heard 3,000, that it applied 3,000 to single filers. They maybe assumed that then the spouse, if they were married, might get another 1,000.
Not the case. Oops.
Is 3,000.
And that's 3,000. That's just in that year, but
just in that year. I mean, you can carry it forward.
Okay.
Until you exhaust that in increments of 3,000.
So you could have a $10,000 loss and then carry it over the next 4 years and take 3,000, 3,000, 3,000, 1,000 off here.
Yep.
Okay.
Yeah. Yeah, which is, I mean, at least you get to keep it, but that's maybe not the most beneficial way that you could do it. So we'll touch on that a little bit later, because I have a little more information on that. But I want to get to some of these other questions real quick. So one of the questions was, can you please explain long-term and short-term tax difference in ROBINHOOD? Went through that. Let's see, this next one is great info, but one thing is very important for new investors to know: when do you have to pay taxes? Meaning, if someone trades penny stocks with a $250 overall portfolio value, they don't really have to worry about this. Another important thing is capital gains tax. If I'm not mistaken, if your gain is less than 2.5K, you don't pay it. Please explain if you can. That's another one where there's a little bit of misinformation going on there, because you hear capital gains tax, and if you don't have the distinction of short-term or long-term, it's widely different. So I'm wondering if this person may have spoken with their accountant, their situation was such that they were in, they had a little bit of room before they hit that 15% threshold for long-term capital gains. And so they interpreted that as, oh, well, $2,500, I get to, make $2,500 of capital gains any year and not pay taxes on it. It depends on your personal situation, if it's long-term or short-term, what other income you have, and how much extra wiggle room you have before you start hitting those other thresholds. So that's that one. Another one is, say I make $4,000, how much would I roughly expect to pay in taxes, or does it vary case to case? Again, it's going to vary case to case depending on whether short-term, long-term, and what bracket you're in. So that's, and what state you're in, because you've got to do that as well.
I'm not in the state tax. Oh,
right. So let's see. We have, actually, this one is actually more of a question for you, but I just want to go through it real quick and add my little 2 cents. It says, hey, Jason, recently started the game of stocks. I'm a college student and have limited funds, but still put some aside each week to invest. I love that. I haven't really thought about taxes. Are there any resources you could provide, beginner tips, things one should generally know? Honestly, from the CPA end, I just say get a general understanding of how taxes work. Like, if you need to rewind the video and watch it a couple times and look at the resources that I sent over, then do that. Honestly, that's going to be the most beneficial thing you can do from the CPA side. But from your side, I'm sure you have some other.
Yeah, that's a whole nother. That's a whole nother hour, 2 hours, or.
Stay tuned.
Stay tuned on that. And yeah, speaking on the college student, and I'm not sure if that was from Harvey too, but he's asking how badly would those rates be if I'm a college student who gets financial aid? And are we, Harvey, are you talking about like you're not working, you don't have any income? Or, and what rates are you talking about? Like just the capital gains rates? Let's see if we get a response. Usually it's like a second or two delay. But.
So I'll start talking, and when we get more information, I can maybe adjust the direction. But when you're a student, generally you don't have a really high income. So again, it kind of depends on which tax bracket you fall in, and it depends on whether you have long-term or short-term. Knowing that we're talking to day traders, I'm going to just assume that we're talking short-term, which means it's just based on your brackets. Now, something to be aware of is that all of your income, really, no matter the source, is going to be looked at when you're applying for financial aid. So it may adjust how much you can get in grants if you start making good money with day trading. It may affect if you're out of school and you have student loan payments through the government and income-based repayment plan, it'll affect what you qualify for there as well. So weigh the pros and cons in those cases. I personally really recommend people go through federal government for their student loans, simply because, yes, the interest rates are higher generally, but they kind of set you up with a bankruptcy insurance option by giving you those income-based repayment plans. Or if you come out of school, you can't get a job, you're not now still expected to pay $2,000 a month. Which, if you go with a private lender, yeah, your interest rate is lower, but you have to start paying pretty much immediately, and they're not very forgiving. So I go the route of don't go bankrupt, right? Pay a little extra in interest, and give yourself the wiggle room. Because for my case, I started a firm out of school. My husband started a medical practice out of school, and so we needed that flexibility. We would have had ridiculous loan payments if we had gone private, which unfortunately a lot of financial advisors will say, consolidate for the low interest. you might get screwed. So we went on a little bit of a tangent there, but as far as the capital gains and your sales affecting your student loans, it does. So keep an eye on that.
Okay. No more information. So talk to a CPA before you do anything. That's like one of those things. Like pretty much you're a child, you're a kid at that point when you're applying for student loans,
right?
and you get so little direction.
And it's really sad because it's overwhelming, and unfortunately, they don't necessarily always give you really great advice on that either. Because again, most financial advisors will say, go for lowest interest rate, which is normally going to be private, but that can really screw you over long term. So that said, if you go private, having more income is going to get you a better rate. So it's a little give and take there.
Yeah.
But again, I like the don't go bankrupt advice personally. So
it's pretty solid.
I don't know. I think it's worthwhile. I think if you can get through life, never go bankrupt, and live pretty happily, I think that's pretty good.
Yeah.
So, okay, let's see. Where are we? We have actually had a couple questions regarding the reporting of income and how it shows up with whether it's through Robinhood, your brokerage firm, and then how the IRS even knows how to handle some of this. So let's cover that real quick. The brokerage firm is going to send you a 1099, and it will have all sorts of information on it. It's going to have if you did any sort of like interest or dividends or anything like that, it'll show you that information. It'll show you if there were any federal withholdings or state withholdings. Normally there's not. And then it will go through your capital gains section, and it will divide out your short-term and your long-term sales. Each sale individually, they'll go through details on that, and the most important parts for those is the sales proceeds, which is how much you sold it for, and then cost basis. Cost basis is how much you have invested in that. There are a few ways to get cost basis, but in day trading, normally it's like, this is how much you paid for this set of stocks, right? So they use those two things, how much you sold it for and how much you bought it for, ultimately to find out your profit. And the profit is what ends up ultimately going on to your tax return. You will, from my end, knowing the back end of it, you end up putting all of the information in. But the profits is what actually shows up on the 1040, and that's what you're taxed on. So the 1099 is really just there for you to have the information to be able to put it into a tax return correctly. If you put it in correctly, then the IRS knows, okay, this is how it's treated. This all looks right. Okay, here's your refund, or here's how much you owe. The IRS is really relying on the 1099, so they receive that also from the brokerage statement. So if you get a 1099 and then submit a tax return that says something entirely different, the IRS will know, and that's how you get audited. So don't do that. But once you put it into the tax return, then the IRS says, oh, okay, so you had this other income, you had a you had a $10,000 loss. We let you take $3,000 to offset your other income. Great, here you go, all set. And one of the other questions was how the IRS knows, and how even your financial advisor knows when it comes to thresholds like being able to contribute to a Roth IRA, right? Ultimately, you ideally should have a financial advisor that works alongside your CPA, because your CPA is honestly going to know a little more about your financial picture than your financial advisor, ironically, actually. So the reason I say that is, again, with day traders, you have the option of having deductions. So if you make, say, $100,000 in sales, well, that's great. $100,000 is fantastic. But how much can we find in legitimate deductions for you to decrease that number, so that maybe we can get you into that range where you can contribute for a Roth IRA? The financial advisor has no idea what those deductions are, or how much you may have, or if there's, prior year carryovers that could apply to that. So that's where you want someone who can work with your financial advisor and keep them apprised of your situation. And if you're nearing a threshold, if you end up contributing to a Roth IRA and you had too much money, you were over the threshold, the IRS charges a 6% tax on the amount that you contributed.
Oh.
They make their money one way or the other. It really but the other interesting thing is though that one of the few times that I feel like the IRS is actually trying to help you is this threshold, right? The purpose of a Roth IRA is you contribute money, you pay taxes when you make a contribution, and then it grows and grows, and later in life you get to take it out without a tax deduction or without having it be taxable income. If you are in too high of a tax bracket, that's not beneficial for you, right? You want to ideally be doing a Roth IRA when you're in a low tax bracket and be pulling it out when you expect that you'll be in a higher tax bracket later. So this is actually important for day traders. Day traders typically don't retire from day trading, right? You don't hit 50, 60 and just decide I'm done, because you can. It's not a manual labor job. It's not something where you just get physically burned out from it. I mean, maybe the stress, if it feels stressful, you might take a break, but you don't so much retire from it. It's just something you do. So ideally, as you get, as you're later in years, you have hopefully built up a pretty good, significant portfolio to trade with. And therefore you're making more money, and therefore you're in a higher tax bracket, which would then suggest that the Roth IRA concept is good for you to have invested early into. You can pull out later when you would have paid more taxes on it. So it's one of the few times the IRS actually is kind of looking out for your interests by saying, okay, once you hit this income threshold, you actually don't want to put into a Roth IRA. You'll put into a traditional, get the upfront tax deduction, and then pay for it later when you're in a lower tax bracket.
Got it. Whether or not they did that on purpose is the other question. It just works out that way.
Well, and that's kind of a funny thing to mention. The IRS normally looks out for their best interest, even in their long-term capital gains rates. It sounds like a really awesome gig, really awesome deal, but ultimately they're just trying to get and keep money into the market.
Yeah.
Right. So they use taxes and tax breaks to incentivize the kind of behavior that they want people to have.
Mm-hmm.
So, okay, so I think we touched on a couple of those with that. That was, we went through the K1s, how that's reported. One of these questions is, do I need to pay taxes still if I crash my Robinhood account? How did the LOL afterwards, right? So,
yeah.
If you made a profit and it's short term and you're in brackets, it depends on your brackets and long term, short term. But if you made a profit, then yeah, they will still value at a 1099.
They said they crashed their account, right? So, but if they made money and then lost it all inside that account,
if you lost it all, if it's from losses, then
no,
it's gonna. But if you made a profit, crash can mean a couple different things. But if that's how you're going with it, then
yeah.
You probably definitely pay taxes if you lost it.
Unless you crashed it in a different tax year.
Right. If it's like some sort of a technical issue crash, then it depends on your profits.
Or you made it like at the end of the year and crashed it the next year. Or yes? Yeah. Then you're still.
Straddling the year would be. I really hope that's not the case.
I hope so too.
Let's see. 3,000. We talked about student aid for college. We talked about the Roth IRA. Let's go to, I've been trading mostly 90% of the time options, and this year invested 3,000 going into almost $7K, which means $4,000 profit, let us know from your CPA perspective what I need to do for next year filing tax and how to reduce my tax going forward. I'm currently using ROBINHOOD. Also, could you provide some examples of what percent to expect to pay in North Carolina to get ideas of my costs? Make it easy for us to understand because the tax world is really complicated for me. And the reality is it's complicated for the vast majority of people, right? So ultimately, this one does go back to, is it long-term or short-term? What tax bracket are you in? As far as North Carolina goes, I looked it up. So some states have capital gains treatments for their income. Others do not. North Carolina does not. They just, all capital gains are taxed at a flat rate of 5.499%. It would be just a flat 5.5. It's 5.499. So expect that out of your profits. And just keep an eye throughout the year of your gains and losses and how that applies to your tax bracket. So if you're in the 15% tax bracket, then know that you should probably save 15% of your profits. If you are actually a tax qualified day trader, then keep track of your expenses, right? So again, those expenses for day trader, home office is a big one, right? So the way a home office deduction works is you take the square footage of your home, the square footage of the space that is designated office space, right? And you apply that percentage to your home expenses. So for example, if you have a 200 square foot office out of a 2,000 square foot home, that's 10%. So you get to take 10% of your rent or mortgage interest, depending on, owner rent. Along with owning would be property taxes, insurance, mortgage insurance premiums, insurance, you get to take one or the other, whether it's homeowners insurance or renters insurance, utilities, if there's maintenance costs, those kinds of things, like you can take that 10% against all of those expenses. Internet's a big one, obviously, kind of important.
Yeah.
For what you guys do. So that's a home office deduction. So keep an eye on those expenses. Keep an eye on phone if you buy a new computer, any of your office equipment, all of those things would be deductible. So make sure that throughout the year you are keeping track of your deductions. Your CPA is going to love you for it at the end of the year if you already know. And then just see how those profits fit into the tax brackets that apply to you. So that's my advice to CPA perspective. Always, honestly, it's really mostly about being aware. Like keep track of what's going on, keep track of profits, keep track of expenses, and where that puts you. And then the last question that we have not hit yet was a little bit long, but I feel like it's going to apply to some people and not to some, and that's fine. So this one says, buying, selling credit spreads usually have expirations with time on it. They aren't being day traded. However, they also usually aren't held for a year like a long-term stock would before closing them out. So are spread contracts taxed any differently than day traded stocks? Unfortunately, no. They're not. I wish I had a better answer for that because that's not really a fun answer. But no, they're not. Then he goes on to ask, or she, I don't know, are credit spreads exempt from the wash sale rule? And if not, will rolling them out further do any good? So the wash sale rule is basically the IRS knows that you want to be able to use or that people are going to try to do tax planning by selling stocks for a loss and then turning around and repurchasing similar stock pretty quickly and getting a different basis in that stock. A wash sale keeps that from happening and screwing over the IRS. So ultimately, if you sell a stock, you can't have purchased a similar, and that's a vague,
Whoa.
Yeah.
undefined concept that the IRS likes to just hunt down on their own. But if you purchase a similar stock within 30 days of selling it, now that's 30 days before or after. So it's actually a 61-day window between 30 days before the day of the sale and 30 days after. So if you don't purchase a similar stock, then you're not going to be subject to those wash sale rules. Now, based on, I'm not fully familiar with credit spreads and the operations, but my understanding is that you are definitely doing that, right? You are purchasing within like seconds of each other.
Yeah.
So that would apply.
Yeah.
The only thing you could do is extend it outside of those windows, and then you'd be okay.
Can you?
But,
So the wash rule, how is that? Who looks at that? Like, how is that enforced, or like when would it be looked at? Because there's like a lot of people are trading hundreds of different stock like all the time, and
all the time. So it's actually it's just reported through the brokerage. So if the brokerage flags it, then they'll report it as a wash sale, and there will be an adjustment on the 1099 saying that this was wash sale, and it basically adjusts your basis to how much you have in the stock. So that's how they flag it. The IRS actually themselves don't go after it. It's just if it's flagged by the brokerage firm and goes on the 1099.
that'll be interesting to see. See
So,
what similar stocks
I'm
are.
curious about that to see how that works, because to see how someone who is doing the credit spreads, how that ends up looking on a 1099. I have not actually seen that myself. So
You'll see that this year.
oh yeah, you have that? Okay.
100%. Yeah, and a lot of them they expire worthless, so nothing happens. But I did have some exercise, so that's actually what happened. It was purchased at a higher price and then sold at a lower price, like immediately.
Right.
Yep.
Right. So yeah, I'll see that.
Yeah.
I guess I'll be able to answer that question a little bit.
Right.
Once I see your next of that. So that was okay. So then the last question, I guess, there was one more question. Why is there a big number when I look at the 1089? Big numbers on the cost basis. That means you put a lot of money into that stock, or the aggregate of stocks, depending on where you're looking. So ultimately, that means you're going to owe less taxes if you have a big cost basis number, but that's because you made less money. So depending on how you feel about taxes versus making money, that's what that number is.
Yeah.
So, okay. So then the last thing that I wanted to mention, now that we've gone through, the basics and the questions before we, start adding a whole bunch of more questions with this bag of worms. What categories? The 475 election. Do you remember me talking about that with you?
The 475? No.
Okay, so I actually just printed off an email that I sent to you. So the 475 election applies to day traders. It is an optional election and kind of a pain to actually make. But what it does is normally when you are buying and selling stock, you are taxed when you sell the stock. Just like if you were to buy and sell shirts, right? You bought it, you're not taxed on it until you sell it, and then the IRS only cares about the profit. There is an election that allows you to do two things ultimately. It is that at the end of the year, you can pay taxes based off of the increase or decrease of the value of the stock. So if the stock increased, you would pay taxes on the gain, even if you didn't sell it. And if it decreased, then you would receive benefit from the loss, even though you didn't sell it. Right? So this it kind of sounds like a neither here nor there kind of concept until you apply it to day trading. So day traders, if you make a profit, you pretty much sell it. Right? You don't hold it very long. The only reason you would be straddling the end of the year with a stock still in your portfolio is because it took a loss, right? So in the case of a day trader, this could be beneficial. Now, the other element of it is capital gains are taxed as ordinary income, or are taxed by ordinary income brackets, but they still are considered capital gains, right? When you do this election, you lose the capital gain categorization, and it's just ordinary income, which means if you produce $10,000 worth of losses, you can take all $10,000 worth of losses. You don't have that $3,000 threshold anymore. So this is only beneficial to people who are day trading like big time and with significant amounts in their trades. So for example, if you're only putting like 100, 200, 1,000, even maybe up to $5,000 in your trades, then straddling the end of the year is not going to make a huge difference in terms of loss. Also keep in mind that if you make that election, your tax preparation is going to go up. Your fees are going to go up because the CPA then has to go track down the fair market value of every trade or every stock you still own and report it appropriately, right? So it can be hugely beneficial for people who are trading big time. And, hopefully everybody watching this at some point will get to that point where this is beneficial, but it's definitely not something you want to just jump into because it sounds like a good idea and you're not there yet. So that's something you want to talk to your CPA after they've kind of seen how you trade and make that election. Now, if you happen to be in the boat of that is actually beneficial for you, you have to make the election by the time your tax return is due for that year. So, for example, most day traders are going to be taxed as sole proprietors, even if they own an LLC. LLCs are cool; you get to choose how you're taxed. But so a sole proprietor, their tax return it's part of your 1040. It's due April 15th. So if that's an election you're interested in, you need to have that in by April 15th. The IRS did not make exceptions on whether you filed that one on time. There are some things they will do it for, and that is not one of them. It's actually really funny. I was looking at it, and the IRS outright says that if it is going to benefit you and not the IRS, we will not do it. Right? Like we assume that, but that is one of the cases they just outright said it. So.
Yeah, I do remember that. I didn't know it was called a 475.
Yes, so that's the portion.
Okay. Yeah.
So that probably opened a can of worms, but I don't know. Was that a cliffhanger to leave people on, or are there more questions?
I think we got most of it. Let me see. There was one. Optional loss or absorbed. I think. Oh, I think this was already answered. Pretty much just about watch sales. Okay. Yeah, it's about a watch sale and then like rolling an option out into maybe another year. But I think since the Roth rule only applies to large chunks and an option's not controlling that much, it's probably something that's not even important. Like an option cost or whatever is just going to be, it's going to be hundreds of dollars. So probably not worth applying the wash rule to. And the brokerage will automatically do it, right? If it's exercised, though. Yeah.
Yeah, the brokerage will flag it. That's if the brokerage flags it, you claim it. If the brokerage doesn't flag it, then on the CPA side, you assume everything is good.
Yeah.
Right?
Okay.
Because you don't want to I don't know.
So we don't have to think about it, pretty much.
Right.
Yeah.
And
okay.
Think about it if you know you're doing it, right? And you want to know the rule, and you want to know, well, okay, if I sell it now and then turn around within the next 30 days and buy it back again, there's going to be a wash sale issue. And that's going to be flagged, especially if it's the state stock, right? So that's something to just be aware of. Know the rule. understand that. But otherwise, if it seems like, if you don't stress too much about, well, is this too similar? Because there are set rules on that. I wish there was a lot more guidance on what is considered similar. But there's not. So if it's flagged by the brokerage firm, it'll show up on your 1099. If not, then you're good to go.
Yeah, and if a spread is exercised, it's already done. It's already washed. That's like worst case scenario in most of the spreads people are trading anyway. So yeah, well, I think that's pretty much everything then, and totally a ton to digest.
It is definitely a lot to digest, and we went through a lot really fast. So if people end up, watching it a couple times, especially that first section where we went through like 6 major concepts, then at least again, like you said, at least it's on video. You can watch it as much as you want.
Yeah. So I know you're super busy this time of year. Are you taking on any more people at this time?
No, I am taking on more people, okay. But they have to be potentially willing to accept. I am pretty busy. I have quite a few clients. I do my best to not have to extend people, but if I get a major influx, then you just have to know that we might want to extend, and especially if you are, if you're brand new and you don't know the ropes, there's kind of a little bit of training that goes on as well, just to kind of get you up to speed. These are the deductions you need to look for. What else do you have going on? If you own another business, we've got to track down those expenses, rentals, all of those things. Like the first year always takes a little more time than all years. So, for sure. I'm always taking new clients. It's just a matter of can we get all of your stuff in and done in time.
Yeah. Okay. All right. Well, thank you so much. If anybody is interested, all of Sarah's information is down below. So we have your website and your contact phone number, along with the video that we went over, all the day trader status things that we weren't able to go through in detail here. So.
Great. Well, thanks for having me.
Yeah, thank you so much. Last question. Do you have a favorite stock?
Do I have a favorite stock? Oh gosh, I like penny stocks.
Oh, really?
Yeah, I love penny stocks. They're great. You can put a lot of money in it, get a little growth, and it makes a lot of money. Right?
Awesome.
Penny stocks are great. I'm not really interested in long-term stocks, and when you have a favorite stock, it's normally because you expect long-term growth. So yeah. Penny stocks for me is where it's at.
Cool. All right.
Yeah.
All right, guys. Let's see. Everybody says thank you, Sarah. Let's see. Going to watch a few. Okay. Sounds like we might have questions later, but we'll try our best. So we're gonna go ahead and end it here. Thank you, guys.
Okay. Well, have a great weekend.
You too. Yay.